Real estate is one of the best asset classes to give you that passive income. For the longest of time, real estate has only been associated with brick and mortar investing. But over the last several years, real estate, various different avenues have shown up. REIT is as simple as buying a stock.
What's the kind of ROI that one should expect on a REIT?
Ashish Khandelia is the founder of Certis Capital. He has over 20 years of expertise in the real estate industry. Today, he joins us to share his insights on how to invest smartly in alternative real estate.
75% of Indian real estate ecosystem is developmental. We have touched close to $9 billion of institutional investing, which is highest ever in this 2024. Two reasons to do alternative real estate investing. So one is, and the secondly,
Why would you say that investing in a REIT is better than traditional real estate investing? Hi Ashish. So let's begin by talking about alternative investment in real estate, and that in the last quarter of 2023 surged to about $418 million.
Right.
What is alternative investing when it comes to real estate, and how is it different from traditional real estate investing?
No, I think that's an interesting question at this point in time, because for the longest of time, real estate has only been associated with brick and mortar investing, where you got to buy a space, whether it is a residential house or an office or a shop or whatever that is. But over the last several years, various different avenues of investing into real estate have become available, and they are more financialized. In the sense, for example, very simply, instead of buying gold, today you can buy gold ETF. And it is giving you the exposure to gold without you going through the cumbersome process of actually buying physical gold, storing it, then selling it and all of that stuff. So similarly, in real estate, various different avenues have shown up. I mean, one of the most known ones are REITs, real estate investment trusts. In India, the first real estate investment trust or REIT happened in 2019. Since then, 3 more has happened. More recently, an SM REIT, which is a much smaller format of the REIT regulations, have come, and the first one has just gotten listed. But beyond the REITs also, which allows you to participate in rental income, in rent generating properties, whether it is offices or whether it is malls or could be warehouses. There are many other avenues also that have come up. I mean, one of the other avenue that is taking shape is secured debt investing in real estate. I mean, earlier it was available only in the form of AIFs. Okay. So AIF is another way of investing in real estate, where you have AIFs targeting developmental finance, generating high teen returns. There are AIFs which are targeting, again, rental property, either build out of that rental property or acquisition of operating assets. And now we are kind of going further down, where similar to NBFCs, you buy a corporate paper of a lot of NBFCs and all that stuff, which give you fixed income return, anywhere between 8, 9 to 11, 12%, depending on the rating of the paper. Even real estate is starting to develop its debt capital market, and where you can invest into secured debt of real estate projects and all that, which can give you early teens to mid-teens returns.
So there's a plethora of options that are available.
Yes.
Who is alternative real estate investments most suited for as an investor profile, according to you?
Right. So in my view, honestly, as an investor, as you start your investment journey, I mean, the initial set of investing probably is done in the simplest of investment options, which are mutual funds, both equity and debt. Of course, a lot of people keep their income in fixed deposits, but honestly, the fixed deposit rate with full taxation on that does not even beat inflation. So you keep only that much money, which is really required from an emergency and all that point of view. But to begin with, your equity mutual fund may be a first call. But once you start growing a little bit of your wealth and you want to generate some passive income, especially people who are in their mid-career to even in their later part of life, who want passive income. I mean, real estate is one of the best asset classes to give you that passive income, whether it happens in the form of fixed debt investment or whether it happens in the form of rental income. Because the reason I say that is your rental income of 6-7% plus there is a capital appreciation on it. So, so you are not really losing value of your money, or the fixed return instruments are any which was giving you anywhere between 12 to 13, 14%, which are almost 2 times the income of a fixed deposit. So I think slightly more mature people in their investment journey, I think they will be better off starting with this.
Okay, mature people in their investment journey. And I'll break down the numbers with you in a bit. But let's talk about REITs in specific. Give me an example of if a person wants to invest in a REIT versus a traditional real estate. In traditional real estate, how do the processes differ?
Investing in REIT is as simple as buying a stock. It's a listed instrument. You follow the exact same process. You put in a trade with your broker and you buy the unit of the REIT, right? As opposed to that, if you have to buy a physical asset, you really need to identify that asset. You need to diligence the title of that asset. You need to go buy that asset, register it, and then manage it through its life and then exit it when you want, right? So I think the REIT is a financialized form of rental income assets. Also, REIT as an asset class will come with professional management, and some of the best in class assets. Whatever is in REITs today are some of the best in class offices or retail malls in the country, right? And there is a professional management which is running these spaces, right? The difference that happens though, and why it gets a little bit complicated for many individual investors not so initiated on the REITs, is that when you buy a physical asset, most people have a view. They're buying in their neighborhood. They know, okay, what is the per square foot price? They have some view on what is the rent gonna be, and they get a touch and feel of that physical real estate. On the other hand, when you're buying a REIT stock, in a way it is similar to you having some view on that value, that per unit price of the REIT. And you need to have some level of financial sophistication to understand that, or you need to have a financial advisor who will give you guidance around that, which a layman may not have, and that kind of becomes a barrier at this point in time.
Okay, so why would you say that investing in a REIT is better than traditional real estate investing?
So let me put it this way, to be honest, I don't think it is so much a question of better versus worse. Okay. It is really a question of choices. Okay. And let's say if you're an HNI and you have the infrastructure, you have a family office, you have the sophistication to do it, I mean, there's no problem. You should go ahead, buy a physical asset. People have different preferences. They can buy it under construction with slightly more risk to fully leased with much lesser risk. But it needs a bit more cumbersome process, and it is much chunkier. Like a per unit investment in a physical asset at the bare minimum will end up being 50 lakhs, 70 lakhs, crore, or whatever that is. In REIT, it could be like 10,000 rupees. Yeah. So one is that, right? The second thing is physical real estate assets are far less liquid. Yeah. REIT is very liquid. Of course, when you want the liquidity, it may not be trading at the best price, but that liquidity is available. So I think that is second. The third thing is really, if you have understood it, you're actually having the ability to take exposure to the best-in-class assets with some best-in-class management teams, which all of us, I mean, more than 50% of Indian wealth is in physical assets, by and large that being real estate. So I think all of us think of ourselves as some level of real estate investor in that sense. But the reality is, as an asset class, it is also evolving. It is getting very professionalized. And similar to, like, you go back 30 years in equities, there weren't really mutual funds. Yeah. And most of the money was invested directly. There was a lot of, tip-based investing, this, that, etc. Today also, not that it is not happening, but large flow is through mutual funds or managed services, right? I think real estate is just starting that journey.
But if I'm being honest, there's a lot of sort of thoughts associated with REITs, or perceptions associated with REITs, right? It's risky. Why should I do it? I'd rather have, and especially it's ingrained in us, traditional real estate investment is the way to go. People like my parents would never think of this, right? What do you want to tell them? What are the myths that you think need to be busted about REITs?
Yeah, more than myths being busted, it kind of going back to the same point. So when you have physical real estate, and you generally do physical real estate where you have a association or you have a familiarity, right? And you're able to visualize it. You want to buy a floor in this office, this office, you're standing here, you can do that. But when you buy a REIT, you you don't have that familiarity, you have to analyze it very dispassionately, like any other financial instrument, right?
Yeah.
And a lot of real estate investment is actually done with a certain amount of passion or a certain amount of, personal interest in that.
Yeah.
I think that difference, as you said, your parents may just never consider it. I think a lot of it is because of that. And the other thing is, I think one thing that needs to be understood a little bit about REIT especially is that because it is listed like a stock and gets operated like that, initially it has reduced but initially people also thought as an instrument it will behave like that.
Yeah.
But that's not true. I mean, even within stocks, you have large caps, small caps, have different level of volatility. But REITs as an instrument should have much lesser volatility. So a typical way of thinking about REIT investing is at whatever price you are investing into that. REITs give you regular income on a quarterly basis. They distribute the rental income that they get in the form of either dividends or rent. You should generally be getting about 6% plus minus post tax. That kind of is like a rough rule of thumb for people to look at. And then on top of that, if you get about 4-5% appreciation, which is the typical inflation rate, and underlying being a physical asset, that's what you should be getting. So you will somewhere land up at about 10-11%.
Okay.
Post tax return, which is actually quite good,
Decent.
not bad at all.
Yeah.
And it should not have the volatility of a stock.
Yeah.
But if you buy it with a stock mentality, you will get disappointed because then sometimes you are expecting a lot more.
Yeah.
Which is this not, no stock gives you 6% dividend yield.
Yeah. And what are the key performance metrics when it comes to REITs? You were talking about dividend yield.
The key metric really is that, one, of course, you really need to look at the quality of underlying portfolio. Currently, all listed REITs have a decent one. You really need to look at their occupancies. You need to look at rental trends. You need to look at occupancy trends. Are they going up? Are they going down? Like any other investment or asset class, you need to have a bit of a view on, do you have a sectoral view? Is it going to go down? Like, for example, post-COVID, there was a lot of stress, right? A lot of offices were getting vacant, rents were not coming through, etc. Occupancies have dropped. Now we are a little bit in the reverse trend. So you got to look at those kind of parameters per se. You need to look at the price, and you need to look at the dividend yield. That is what is very directly impacting you. But the other factors will help you get some sense on, is it going to appreciate?
Yeah.
Because if there is a very high degree of vacancy, then it needs to be either reflected in the price, or if it is not, then you may be buying it more expensive, right? So yeah.
Okay. What about the regulatory view and the taxation when it comes to REITs?
So that's a bit more nuanced in case of REITs. Regulatory view is, I think, like now it's a very established product, so I don't think anybody has to worry about the regulatory part in this by and large.
Taxation.
So on the taxation side, it's a little bit more nuanced, because the distribution that come out of REITs, that happen in 3 components. I think it is dividends, it is amortization of debt, and it is interest income. And while dividends and amortization of debt is tax-free, interest income is taxed. So each REIT tells you which are these 3 components, and therefore the taxation of the distribution is different for each REIT. And you need to kind of look at that. And therefore your post-tax yield will be different from between each of them. So to that extent, it's a little bit more cumbersome and nuanced, and you got to get into the specifics of that. Yeah.
Are you aware in terms of numbers if people are becoming more receptive to investing in REITs? For example, in India, is this a trend that's growing?
I think it's growing.
Do you know how much as a percent, maybe?
We don't know. I don't know how much as a REIT percent it is growing, etc. So to that extent, I think there is still some time. Also on the InvIT side, the dividend yields had been higher, though InvITs generally have a little bit of a depreciation of asset, whereas in REITs there is an appreciation. But the current income in InvITs is higher than REITs.
Can you break down the difference between the two?
So InvITs is more infrastructure assets, your road assets, your transmission lines, etc., right? So I think that, so to that extent, and there, many of those assets have a fixed life. So they amortize their asset over that life.
So I know you spoke numbers, but on average, what's the kind of ROI that one should expect on a REIT?
So your running income, dividend yield post tax should be somewhere around 6% is where I would like to buy a REIT. And then you can reasonably expect that in a stable market, I mean, if you're not seeing too much market dislocation over a period of time, if you hold it for 4-5 years at least, you should be getting an appreciation of at least 4-5%. Rentals increase, inflation, that will all flow through to the price of the REIT. So then overall you will end up making possibly 10-11%.
Let's talk about how the adoption of REITs has been in India as compared to what we've seen across the globe, as well as alternative real estate investing as an avenue.
So I think globally, the REITs is a very, very established asset
Yeah.
class. I think a lot of pensions, a lot of institutional investors. It's part of the core asset allocation for many. Globally, office as an asset class has suffered massively and has still not recovered. Right? Globally, if you will look at it, I think post-COVID, there has been quite a bloodbath for a variety of reasons. If interest rates go up, asset classes like REITs suffer, right? And that is what happened in the US. I mean, the interest rates went up quite a bit. Now, only this year, in the last 3 Fed meetings, they have reduced the rate, but still high. I mean, it's still 4.25 to 4.5% after yesterday's action. Plus, there was a lot of vacancy, and still this whole office occupancies are nowhere close to where they were post-COVID. But as an asset class, overall, REITs have been well understood, are like fairly 3-decade-old products there. So I think there it is reasonably well adopted in the global context. India, I think we need to kind of see this journey over the next 10-15 years, and it'll happen. It'll happen, in my view, right? The other thing that is also happening is that like for example, DLF is a very, very large player, but they have decided not to yet bring their stock as REITs. So it also is that only a limited amount of office stock has come out as REIT right now.
Okay.
And there's a lot there. Now people will bring that in the form of a REIT.
But you see that changing, evolving, growing?
So there also people are taking both views. I mean, people are in two minds whether they bring it in the form of a REIT or they can just bring it in the form of a company.
Yeah.
So to give you two parallels, there is Nexus REIT, which own a lot of retail malls, and then there is Phoenix, which also own malls, but they also develop those malls, they pursue growth opportunities and all that.
Yeah.
And in a way, both have, to a certain extent, similar underlying asset classes.
Yeah.
But Phoenix is also a full-fledged development company,
Yeah.
associated with asset owning company. REITs are only asset owning companies.
Okay.
So I think so people who own these malls or who own these assets and who also develop them, they are also, as the journey of REITs play out in India, also making their own decisions in terms of whether they want to go down the Phoenix path or whether they want to go down the Nexus path.
For an investor, any maybe behavioral aspects you should consider if you're going down the Phoenix path or you're going down the Embassy REIT path or Nexus or whatever?
Yeah, so I think from an investor point of view, the behavioral aspect that I can say of is one is the standard behavioral aspect. I mean, because these are listed instruments, certain news, certain things can cause significant volatility, and you should not give in to that volatility. I mean, that just is standard for not REIT specifically, but any of the investments. The other thing is a REIT is a little bit more of a stable asset. So if you want less volatility and a little bit more stable income, then maybe REIT is better for you from that perspective. If you want a higher growth aspect, then something like a Phoenix versus a REIT will play out better.
So from a behavioral aspect, what kind of a temperament do you think one needs to have investing in traditional real estate versus in alternative real estate platforms or REITs?
Yeah, so I think it needs a bit of a mindset shift.
Okay.
We kind of touched upon this earlier when we talked about the examples. The thing is, people are just very comfortable with physical real estate. Any kind of an alternative real estate or any kind of an alternative product needs to develop that trust. So what I would say is that one, first of all, people need to become open to these, because as we have seen, and again I go back to the mutual fund example, for an average investor, a mutual fund is a much better way to participate in equities and a much easier way to participate in equities than trying to do equities directly, right? In a similar way, for all your other asset classes, this is the same journey that they will follow, right? Fixed income is a nascent asset class. Real estate is a big asset class from a personal wealth holdings point of view, but not from a managed point of view. So, one, you need openness. If you kind of consider it, it will be so much easier for you to participate. You know, your investment sizes will drop. Otherwise, investing in real estate, the biggest deterrent it is a very high ticket size.
Yes.
You know, it may almost be the life savings for many people, right? But alternatives give you an option. The other key thing to do is that in general, real estate is a long-term asset class. So if you're investing into that, you know, you should have a 3 to 5 year view of staying invested. Even with REITs, we spoke a lot about REITs. It will play out in that fashion only. If you want to get that 4-5% capital appreciation, will go like that. Even if you're doing, let's say, alternative secure debt in real estate, then also generally those papers will have a maturity profile of 2 to 4 years, right? So if you stay invested in 2 to 4 years, you can make that 14-15% return, right? So I think you need the horizon, you need the openness to try that. Maybe start small. If you wanted to invest 100 rupees, maybe start with 25 rupees, you know, in that sense. The other very important aspect is that, and that is again true for any alternative investment, especially for new emerging ones, and most of the real estate ones are new emerging ones. Really look at the team. Like today also, when people invest into mutual funds, all the financial advice, they will track the performance of the fund manager. They will track whether a fund manager has left, moved to the other company or whatever that is. In a very similar way, you've got to similarly look at what is the underlying team, how experienced they are, is there an alignment, is there an investment by themselves of their own money into the products that they're selling. I think some of these things will be very important to look into.
What about SM REITs? Can you tell us?
So yeah, SM REIT is another interesting product. It's a miniature version of the REITs. I mean, if your typical REITs have 40 million plus square feet of underlying assets, SM REIT typically is targeting one asset at a time, which has to be between 50 to 500 crores, right? So I think SM REIT in that sense is trying to fulfill that space where you want that touch and feel. You don't need that financial sophistication of trying to value a full REIT and have a view on the stock price, and still give you an easy access, right? So it started as fractional ownership, and with the SEBI regulations coming in, you know, it has evolved into an SM REIT product. So SM REIT is nothing but you buy a building and then basically all the unit holders participate in that building, and again you have a manager. Again, the key thing there, I think it's an interesting asset class, and we will see how it evolves, right? I think the scope is there. Key again is very new. Lot of platforms also are very new. So very, very important for the investors to really look at the quality of the teams, the quality of the investment expertise that is bringing the SM REIT.
Any sort of a risk profile you need to have if you're looking at SM REIT?
I think, in my view, it's a reasonably suitable asset for many investor categories, because it is again not supposed to be volatile. It is a ready asset. Everything is there, right? And you get a decent sense on at what return it is being priced when you're going in, right? So that way, but again, I think you should be cognizant of they being illiquid. Because again, a new instrument and they may not have that much liquidity, so you should have the horizon.
And looking at alternative real estate investments as a whole, how do they help in diversifying one's portfolio?
So see, I think on the alternative side, I mean, again, the thing that I spoke about, so we talked about REITs, which can give you income generating. But really speaking, 75% of Indian real estate ecosystem is developmental. We are a demographic which is a basically young country. We almost produce 4 to 500 million square feet of real estate, new real estate every year, of which about 350 odd million square feet is actually residential. And the balance is in these other asset classes, you know, your offices, warehouses and all of that stuff. So today you have different options through AIFs, through REITs, through debt capital markets to actually take a position in real estate. And the way they help you diversify, we are in a very strong housing cycle. I mean, today only I think there was an ET article which kind of mentioned that we have touched close to $9 billion of institutional investing, which is highest ever in the country in this 2024. And 45% of that share has gone to residential. Now, if institutional investors are kind of doing that, you as an individual, how do you benefit from that? Historically, you will go and buy a house, but that may not actually give you the same return. On the other hand, if you think of secure debt investing in real estate, that can give you 14-15% return. You know, I mean, institutionally, people have done all that, all their life doing that, but domestic investors really never had the option. Now there are few options available. You can invest into some of the AIFs, which also mimic the strategy, but there the minimum ticket size is at least ₹1 crore and upwards, right? You have warehousing AIFs. So warehousing has been another kind of an asset class. We don't have any warehousing oriented REITs right now, so the only way to participate in that is if you go to an AIF. So to us, the most interesting avenues right now, if you want to do alternative real estate investing, and the two reasons to do alternative real estate investing is truly pick a good manager who really knows his job. Then only he will produce good returns for you. And the secondly, you can do it in a far more easier way as opposed to trying to deal in physical real estate, which requires a lot of effort, right?
And emerging trends, you were saying?
So in that, I think in my view, consider the housing, and in participating in the housing, consider secured debt versus buying the house, because housing prices are already up by 40-50%. So I think the appreciation will be more tepid right now. But the secured debt can give you a mid-teens return kind of a profile. You can consider REITs, which we talked about. I think these are the two areas which will give you good passive income without compromising returns, in my view.
What about exit strategies? What should one be looking at?
For a REIT kind of an instrument, there is no exit strategy needed, but I would say a horizon of 4-5 years should be there, because it's a completely tradable unit. For other things, really speaking, they are managed products. So as an investor, you should not be required to worry about the exit strategy per se. Most secured credit in real estate is self-liquidating, because the projects get built, they get sold, money comes back, typically within a 2 to 2.5 year period, right? For AIFs, the duration is actually generally much longer. They take anywhere between 4 to 5 years or even 6 years for the money to come back.
Any advice for someone who has never ventured into this and is exploring alternative real estate investing for the first time?
So my advice to that is, it is a good time to certainly start, because this is going to become big, right? So you will have familiarity as this asset class grow. If you have never done it, start small. Don't put in too much money into that. Thirdly, marry these 3-4 factors. What is the corpus you want to invest? What is the duration that you have on that one? And what is your risk appetite? You know, you can be in a 10-11% product, you can be between 15 to 18% product, right? So depending on your risk appetite and the corpus that you have. But please always research well as to what that product is and what that fund house or investment manager is. Because it's like in a mutual fund, yes, you can go to an HDFC, ICICI, SBI, you can just take the brand and go after that. I think these products are still newer, so you need to invest a little bit of time and energy in understanding those people and brands.
You said as your personal investment philosophy, you would look more at credit. Can you tell us what it is about and how it works?
You know, a lot of real estate is capital intensive as a sector. So when you build these projects, it needs a fair amount of capital. Now, for the longest of time, this capital was only available through institutional investors, and that is what the trend continues. So what it really is that it is capital that allow these project developments to happen. So developers borrow it. It is secured by the underlying project, the cash flows from that project, the receivables, the personal guarantees of the people who are building it and all that stuff. And it can produce almost anywhere between 12 to 15% return. So to that extent, I think it is a much healthier return or a higher return compared to your typical fixed income products. But it needs a lot of sophistication of the team which is doing this credit and managing this credit.
So what's the future of alternate real estate investing? Do you see it coexisting with traditional real estate investing, and do you see more people adapting to it as well?
100%. I think the future of real estate alternatives in general, and real estate alternatives as a category of alternatives, I think both is going to see massive amount of growth going forward. I think it is also coinciding with a lot of various kind of fintech platforms, a lot of investor education, financial education that is happening, which is important for alternatives to grow.
Okay.
And in India right now, the participation in alternatives is still very small compared to where the averages globally are.
And how important is it to consult a certified financial advisor as well while going through these steps?
It's better to consult.
Yeah.
I mean, really, it's an individual choice how
Yeah.
you feel about your own expertise about that. But if you're yourself not a financial expert or not something that you're willing to invest a lot of your own time into understanding, that it is better to have an advisor.
Thank you so much, Ashish. It's been a pleasure interacting with you. So there you have it. Alternative real estate investing is definitely an emerging platform. It's great for generating passive income. The corpus needs to be looked at. You need to understand your goals, your risk profile. All of that is very important before putting your money to work. And of course, a lot more needs to be done in terms of the adoption that is growing. And it's important to consult your personal unbiased financial advisor as well. Do let us know what your key takeaways were from this episode. We'd love to hear in the comment section. And do remember to subscribe to Personal Finance TV. Thank you so much for watching this episode. I'll catch you in the next one.